Good afternoon, everyone. Welcome to Asian American Chamber of Commerce virtual event. I'm Stephanie Shea, work for M&T Bank and serve as the board chair of Asian American Chamber of Commerce. Luckily, AACC has great board members, and I'm going to introduce one of them now, Mr. Ken Fang. Ken is the president of MobileMo LLC, a mobile web cloud strategy, design and development company. Most importantly, Ken is leading AACC's GovCon committee. We started from scratch and now we have about 20 members in this committee. Each member is so active. Thanks for Ken's leadership. Ken, over to you.
Thanks, Stephanie. I know that I'm between you and the main show, but we do have a couple of things that we wanted to just get out there for our membership to know about upcoming opportunities, a little bit more about AACC. I'm going to try to get through that pretty quickly. So as Stephanie mentioned, we have a very active board. Anybody that would be interested in helping out and helping to grow and becoming more involved in AACC, definitely give either me or Cindy or Stephanie a call. And we're more than happy to have any sort of assistance that people can give us. Membership benefits, we obviously have a large number of networking events, and can get you representation in the community. We have a lot of sponsors that we're very thankful for. I'm not going to go through all of them, but thanks very much for everybody's support. And upcoming things are how to stay top of government buyers' minds. It's a training seminar on Friday. We have a virtual speed networking coming up on July 28th. CMM Level 1 compliance workshop coming up in August. And a member showcase coming up in a week following that, August 13th. And then finally, we have virtual new and prospective member orientation every month. So those are the dates on the slide. And just a very quick introduction next of Polity, who we're excited to have moderate this particular event. So Polity is the CEO for Harmonia Holdings Group, LLC. She has an extensive track record of building and operating successful technology and technology-related services company. She acquired Harmonia in 2006 and has since then grown it aggressively as it seeks to develop specialized technology and technology-enabled services geared towards the federal and commercial sectors. She is an entrepreneur with a unique understanding of technology as well as business and strategic issues. In addition to being on the board of the Asian American Chamber of Commerce, she's also on the board of TIDC, the Army Sciences Board, and she serves on the NVTC's Executive Circle. Her bio is way too lengthy to read, but she's definitely my mentor. So we're glad to have her, and she's taught everybody on this GovCon a lot. So without further ado, Polly, I'm going to turn it over to you.
Thank you, Ken, for such a lovely introduction. I could learn a few things from you. It's not the other way around. But I'm very excited to moderate today's event, and more so because the topic is of such great interest to me as an entrepreneur and as a business owner. As you know, many business owners building value in our company and getting it ready for a meaningful exit is always there at the back of our mind. We have so many questions that we could use help and guidance on, things that I wonder about. Should I stay involved in my company? Should I prepare it for an exit? What size should it be? Is a $10 million size good enough? Is it 100 million, or should I try to grow it to $1 billion? At what point should I look at exiting the company? And then what will an investor look for in me personally, in my board, in my team, in my procedures? What do they look for? How do I prepare for that to get a good valuation? What kind of investors will target me? Would it be strategic buyout? Would it be a private equity buyout? The whole list of questions, run through my mind, and I don't think as a business owner, I have all the right answers. And I don't even know who to reach out and when to reach out. Hence the vision for having this particular event, to get answers to all these questions. And then we have among us two industry stalwarts who are experts with a proven track record in the space. But before we start, a note for the audience: your mics are muted out, but if you have additional questions, please put it on the chat, and time permitting, we'll get them answered. With that, it gives me great pleasure to introduce our two panelists, Abid and Jean Stack, Abid Nemuchwala and Jean Stack. Jean has 25 years of investment banking experience. She's a managing director at Bain, a lead mid-marketing investment bank, a very active M&A advisor in the government and defense sectors. Bain has done 56 transactions since 2016 and has a 96% closed transaction rate, a 7.7 billion aggregate transaction value, and an average deal size of 334 million. Wow. Jean herself has been the lead deal maker on several of the recent exits we've seen in the Northern Virginia region, and the very last two, of $500 million value each approximately. Jean today will talk to us from a seller's perspective. We also have Abid Nemuchwala, a very successful entrepreneur and an expert at scaling businesses. He enjoys a track record of delivering mega deals. Abid led Tata Consulting Services BPO practice for 23 years, establishing it as an essential strategic partner to its clients, which resulted in a number of mega deals with large global enterprises across the world. Abid was also CEO of Wipro, a leading global information technology consulting and business process services company. Abid spearheaded some of the largest deals in Wipro's history. Recently, Abid has moved on to becoming a venture capitalist and is founder of Dallas Venture Capital. He's actively mentoring the founders of his portfolio companies as a strategic advisor. Abid will talk to us today from the perspective of an entrepreneur and a buyer. With that, welcome Jean and Abid. Thank you so much for making time for this event. Let me start with a very basic question, and maybe Jean can start first. Jean, how would founders and entrepreneurs think of the future of a company? What should our thought process be?
Sure. Thank you, Pallavi, for having me on this panel. So, happy to get started. There's so much in that question. There's so much in all the questions in the introduction that you kicked off. So, I guess where I would start when you think about exit and what that looks like, and what, I would start with a framework of thinking about it years in advance, before doing anything, and think about what are my, as a shareholder, what are my objectives? What are my strategic objectives? These are some of the questions you asked before. What is the right timeline for me? What do I want my company to look like when it's sold? Do I have valuation expectations? Do I want to exit, immediately, or do I want to kind of stick around and get some liquidity, but do I have years left that I want to pursue? So I think the basic foundation is really information gathering years in advance and trying to think about what that team looks like that you bring, you have on your side as part of a potential transaction. So I think it comes down to a couple of things. One is, what are your objectives relative to, financial and non-financial objectives for business? What is your timeline to achieve it? And what partners do you want on your team? And those partners include an investment banking partner, advisor, financial advisor, but they also include very importantly, a legal advisor as well, your attorney that you bring to bear, and then also partners in it from an accounting perspective, a quality of earnings advisor, a tax advisor, and then of course, a wealth manager partner that you think about planning, because that planning does take kind of years to do it right. You want to start thinking about it years in advance.
So Jean, are you saying that, as let's take Harmonia, right, a mid-sized company, you're going to look at who my accounting firm is, who my legal advisor is, who my bank is, Or is it something that I'm not, is it something between the lines that you're saying?
Yeah, yes. So it may be very direct. So if you're thinking about an exit a couple of years out, you want to start talking to folks like me, at this time, so we can level set. What do you want to, in order to maximize value, what is it that you should be doing with your company to prepare for that exit? It's important to have that in advance. Start thinking through that in advance so that you have time to appropriately position your company. That's one work stream. The other thing is, and again, less suited to certainly what I do, but very importantly, you want your financial planner, your wealth advisor, because there's things that you could do to minimize the potential tax obligations, things that you can do. So having, a wealth manager in place to help you build a strategy around what to do with your liquidity and how to minimize the tax obligations with your liquidity. As you move closer to a transaction, we can, collectively help you select an attorney if you're not already working with an experienced transaction advisor attorney. And it's really important that they're not government contracts attorneys or not, they are folks who do M&A transactions every day. It's important that you have someone steeped both, with appropriate industry knowledge, but also, M&A transaction or, whatever the strategic transactional experience. And then from, an accounting side, we work with quality of earnings firms to help prepare the financial statements, to help present and to be on your side as your partner, not years in advance, but prior to a transaction, as well as your tax planning experts, so that you've got those questions answered as you go in. If there's some tax strategies you can employ to take advantage of certain tax benefits that a buyer may have and minimize tax obligations on your side. And the same thing with a QV earnings provider to help present your company in the best light.
So Abid, now Jean told us from, what I should do from my side, but you as a venture capitalist and with experience in buying so many companies, from your perspective, what does a buyer look for? Because that's important for us wanting to sell, to understand that viewpoint.
Yeah, and coming on this panel, I was kind of adding up how much of companies have totally bought for, and it added up to a few $1 billion. So thank you, Pallavi, for having me on this panel, and thank you to the board of Asian American Chamber of Commerce. Jean, nice to be on the panel with you. To her point and to your point, I think the buyer does feel very comfortable. Obviously, there is in any buyer, I've done most of my buys as a strategic buyer for large cap companies, buying very high growth, high quality entrepreneurial companies. And typically, before even I say what they look, let me tell how this buying process happens. There is a number of deals that either bankers bring or experts from within the industry recommend to look at companies for strategic buyers. For private equity, I advise private equity folks, private equity buys. And two things that become very important. There are two parts of the process. One is what I call the technical process. Everything logical, database, financial due diligence, the contract, legal, all of those things. And that perhaps based on, even different buyers, the answer could get to the same number in terms of valuation or anything that needs to be kind of made a closing condition and stuff like that. But the second part is what I would call as the quality of transaction, quality of the buy, in which I think some of the points that Jean mentioned become very important from a buyer's perspective. So, you asked this very direct question about who's the accounting firm, who's the law firm, who's the selling partner. Sometimes just ease of getting a transaction done is so important, because a lot of times, while every seller would want to be the only asset, and hopefully most are the only unique asset to be sold, the buyer is also a lot of times evaluating between one or more assets to buy. So the ease of getting a transaction done is important, and some of the partners make that easy. The second thing is also, when everything else gets done, the board level decisions, the investment committee level decisions on making it happen, it banks more than you would think on the brand, on the reputation, on some of the team members who are talking about it, some of the network checks that they do. And in that, when you have marquee brands supporting you, are part of the same network, customer references become important. The customers that you deal with, some of the ex-employees at times become important. Obviously, the company's brand and reputation in terms of analysts and market become important. So I think a lot of times starting to look at it, 2 years is a great time frame that Jean mentioned, ahead, and addressing some of those things in a very proactive manner, because these are intangible parts of what could improve the valuation. Eventually, finally, as a seller, what you want to get is get uniquely positioned and get better valuation for it. And those are some of the things that buyers pay a lot of attention, especially when you're last two and one needs to be picked where everything else might look the same. Those are the things you would focus on.
So Abid, that brought a question to my mind, and especially because a lot of us may be government contractors in the audience. When you said marquee brands, we may not have brands, but we have customers in the federal government, and the federal government ranks our performance based on a CPARS, which is a very objective, it's a searchable database of contractor performance. Have you had experience in acquisition of government contracting firms, and do the CPARS hold value, or are we looking for validation? How would you validate our reputation? I guess.
Yes, obviously there are such databases, including in the government and some other places where there are objective scores from customer ratings. I think that's a big tool, and even when you're selling, you should make that as a marketing tool, because it also, when I say ease of buy, making the process easy for somebody to buy, if you're putting a objective ranking table across, which is comparing more than one assets, it becomes much easy to take the decision. So it's part of ease of buying. But also, the informal network does play its part. So I would say both. But obviously, where there are formal scorecards, and I saw some of your events around CMMI compliance, quality scores, customer satisfaction rankings, and I know the overall score includes all of that because it has a lot of the quality metrics in it as well. I think that is extremely important, because what companies do as part of the due diligence and objective evaluation is you open up the data room, they spend some time evaluating, but you can still do only what I would call at best sample checking out of them. So a lot of times, I wouldn't say one, but a pattern of negative comments on the same item could undo a lot that might have been done in the due diligence process. So the intangible becomes quite important as well. And the kind of things you mentioned are important for the intangibles.
So that's a really good point, because the one thing we worry about, and I'll ask you two questions in one, Abid or even Jean. You have employees, disgruntled employees who might leave, and they will have, and that's the problem I have with, what's the website? Now I'm blanking out, where they put all the employee referrals, right? And we try to comment on it. And sometimes I get the approach that let's not comment on the negative, because silence is a more elegant approach. So that's one kind of feedback that you get. And on the other hand, as you mentioned networking, right? Now, I, as an owner of a company, what are you looking for in my networking profile besides the objective measurements? Is it that I should know more VCs, or is it that I should know more, what kind of people should be in my network to create that subjective profile, which is appealing about a business owner like me? So it's a two-part question. Yeah.
Two great questions. And, I'll let Jean add as well, but on the second one, on the networking one, if you're getting ready for this, having, looking at your board and the composition of your board, because the board kind of then multiplies your network. So, just starting and running a company might not have necessarily required you to have a very marquee board or a set of advisors, but especially when you're thinking about, and when I say advisors, these are more advisors like a proxy to board members. So these are not partner advisors, but advisors from within the industry who would otherwise be as good board members as well. Having them on board could help expand that network, because a lot of times you would see that proprietary deals, better valuation and better outcomes. And the network enables, amongst a lot of other things, the network enables the ability to get a proprietary deal done as well. So that's how I would kind of encourage entrepreneurs to start looking at how they can build their network. Again, some of these forums, associations, stuff like that do help. But otherwise, the partners and the brand value, the top 2 or 3 ranked partners that you have in all of the suppliers that you have, especially audit firms, accounting firms, those kind of be a good, especially again, now we're not going into the modes of exits, but if it is an IPO or a public and regulated market, then it becomes even more important. And I'm sure we'll cover it at some point in time.
Yeah, no, that's great advice. I want to move on to my next question. Jean, I think this might be in your sweet spot, or maybe Abid's sweet spot. What is the macro environment today as compared to what it was 5 or 6 years back? We went through COVID, we're coming out of COVID. I thought nothing would sell during COVID. Jean has had like 5 exits that she has spearheaded in the COVID world. So probably I don't understand the environment today. But talk, both of us, in whichever order, talk to us about.
For this question, both a seller's perspective and a buyer's perspective could be contrasting. So I'll let Jean go.
But it's good to understand both, because we are trying to exit, and you need that buyer there to help a seller like me. So that macroeconomic, how it plays into the strategic alternatives that are facing us. Educate me and the audience on that.
Yeah, I'm happy to start with that. And just for the benefit of the folks in the audience, I come at this from an expertise. My expertise is in government contracting, government defense environment. So all the companies I work with are in kind of that area, and most of the clients I work with are sell side, and most are founder owners. So that's a little bit of perspective I come at the market with. So just from a big picture perspective, and during COVID, obviously you had a very big market pause in March, of last year. While folks tried to figure out what COVID meant to the performance of the business and the growth prospects of the business going forward. It was very quickly recognized that in August, that it wasn't going to be so bad, particularly in the government contracting world and in technology environments. Then there was a huge pivot to sellers thinking, oh my goodness, with the administration coming in, what will this mean to me from a tax perspective? And from a buyer's perspective, how can I position myself to be successful for the future? So from a big macro perspective, let's talk about the macro market now. Right before COVID, and now right now, the market is even better than it was. Right before COVID started, we thought we hit a market peak there. We had a pause, a lull, some volatility, and we're back into a very, very strong overall macroeconomic environment. We have public stock valuations, near all-time highs. From a multiple perspective, if you look at multiples, very often we value companies in this industry, in this market, on multiples of EBITDA, public market multiples of earnings. But either way, however you kind of slice and dice it, we are at, again, for the industry, we're certainly at a near 10-year highs from multiple perspectives. So very strong equity capital markets, which means in turn, buyers can pay more for companies. Very strong financing market environment as well, which means there's a lot of capital in there to acquire companies as well. So whether the financing be in support of M&A, or from equity from a private equity perspective, or in support of pipes, as you would need in a SPAC. And I know we're going to talk about that market as well. You have very accommodating conditions, both in the financing markets as well as in the equity markets. And coupled with that, again, as you think of the macro environment, huge surge at the tail end of last year in terms of momentum, very much geared to sellers planning for tax events, significant tax increases. So we had the highest M&A volume in the government contracting industry, significant highs as we reached the last quarter of last year, huge volume. And as we came to realize that, we would tax increases were not going to be retroactive to the beginning, or not likely to be retroactive to the beginning of 2021. A continuation of the M&A momentum into 21. So where we sit today, 2021, this trailing 12 months, is the most active environment ever, second to 2012, right before the last tax changes. A lot of M&A, strategic and financial sponsor. So it's really coupled with, it's a combination of potential for tax increases, accommodating equity markets, supportive debt financing markets, and frankly, more sellers coming to market, thinking that because the market is so robust and quote frothy, now is a good time to sell. And that really is characteristic of the market. So when you look around and you say, there's so many deals being done, there's actually so much volume on the market that the biggest question is buyer bandwidth and their ability to look at the deals that are in market today. And that's both strategic buyers as well as private equity buyers. So just in, I'm sure we'll get to elements that drive value in the market today and how the market is impacted by the current environment. But give the activity actually makes it harder for people from a bandwidth perspective to evaluate different opportunities. So it means that a seller coming to market wants to have be very thoughtful in terms of planning, in terms of timing, and what the reception of their company would look like in a market that is overcrowded with sellers today.
I completely agree with everything Jean said. I think the market, it's a great time for sellers because the valuations are high. I think she very well pointed out that there are a lot of assets available to buyers at the same time, and that does create a level of supply which could create more pressure on the sellers. But I think purely from a market fundamentals perspective, since most audience on the call is from the technology and technology services businesses, the market is good, overall, not just government, but broader technology, software and services market is over $1 trillion, continuing to grow at 5 to 7%. 5% itself means $50 billion of new spend coming into the market. So from a fundamental, and this also, most of this relatively smaller sized companies are more focused on the digital technologies, which is growing much faster. The 5% number is for the overall $1 trillion market, but the $400 billion within it, which is digital transformation, software and services, is growing at a 16% clip, which is phenomenal. So even the fundamental of the market is very, very good. COVID has just accelerated all of that. As Jean rightly pointed out, the first 2 or 3 months, everybody kind of took a step back and took stock because everybody was surprised. But after that, it became very clear that digital transformation plans, whether it is the government, whether it is the private sector, the commercial businesses, everybody's accelerating. The 5-year strategic execution of making a business digital has become a 24-month or an 18-month acceleration. And while a lot of people ask me that, is this a lot of demand which has got fast forwarded and will there be a dip later? I don't believe, because digital is not just one, it is kind of a series of themes that come in. So if you've cloud enabled a customer, the next is you could do a SaaS application deployment and the customers are moving to SaaS adoption. Once you've done the SaaS adoption, you're getting to intelligent automation. You've done intelligent automation, you're getting to analytics and AI and algorithm deployment. You're getting to IoT, and kind of these themes continue, and each one of these themes will peak one after the other. And that's why I am so bullish on the market. And that is why I also believe that it's not only that the valuations are great right now, but they are going to sustain for at least the midterm, the foreseeable future, simply because the technology adoption has accelerated itself very high. The only thing that I want to add over here is that valuations are high, both because of digital services. There is a pricing premium that suppliers are able to command, which gives them better revenue per employee and some of the metrics that go into it. There's better profitability. and there is higher growth because of the accelerated adoption. All this has impact on the multiples, and the multiples are higher. So the type of buyers, again, a couple of strategics have told me that they've shut shop right now to buy because everything has got so expensive. But I'm sure, once it dawns on them that this valuation is the new normal rather than just a spike or overheated kind of situation, those gates will open again. But there are a lot of deals getting done at phenomenal valuations right now. So great time from a market perspective, especially if you want to sell.
Yeah. So I have a question actually from the audience, and they're saying, is it true that if you don't sell this year, then all the buying and selling will come to an halt for 4 years because of the taxation you guys are both referring to? Or is that a myth?
No, that's a great point. The answer is buying and selling will continue for sure. The reality is this year is not the right time for all sellers to sell. Okay, it isn't. It is really defined by the fundamentals of the company. Certain companies that are ready to sell and are in that shape, that have the margin profile, that are in the strategic customer bases, that have certifications and a differentiated offering and have the growth momentum. Yeah, it's a great time. It's a great time to sell if you've got that kind of, if you're ready to sell. As someone who represents companies, and if we talk about purely the sale, it's not always the right answer for folks, number one. And number two, not all companies are sellable in the current market environment. In fact, if you look at a close rate in the industry of companies that go to market, only about 50% of transactions close that are taken to market. So selling is not always the right answer. This year is not necessarily the right answer. And we could talk about attributes of businesses that, might make it, you might say, well, next year might be better. The reality is if the growth of the business in the future and the strategic positioning in the business in the future, next year or the year after, might be a better time. You may, despite the potential tax increases, you may get a better outcome for your business because you're going to win a big contract, because you're going to expand your margin profile, because you're going to enter a new strategic customer base, because you're going to start selling more of a proprietary technology or whatever the case may be. So no, it's not always the right answer. It really is, while the macro environment is good, I would say equally important, if not more importantly, is the company's positioning within the market, and that will determine success of now or later. We've gotten some of the companies that are well positioned in growth areas of the market can sell in any market environment, any market. In 2009, possibly the worst time to sell companies, we got one of the highest multiples we've ever sold a company for, because they were knee deep kind of in a burgeoning cybersecurity market and kind of plowing the way for others. Huge outcome in a terrible market environment. So I would sort of give that as a word of advice, is you don't look around and don't necessarily follow the pack, because while the multiples are high, frothy is defined in the multiples that you're seeing being paid for companies that transact. There are fewer buyers in every process today because of the bandwidth capacity issue. So if we had 3 final bids in a process last year or the year before, we might have 1 or 2, right? So there are definitely fewer buyers in the market today.
So that leads me, Jean, to my next question. What are the attributes that drive value in a company? If we are not rushing to close and sell this year, and we wait it out, like both of you are saying, it doesn't matter, the macro environment doesn't matter, the company has to be ready. What are the attributes and how do we build those up?
Yeah. Again, great question. And I could pull up a slide here, but maybe before I do, I would start off with there's qualitative and there's quantitative aspects of the business. From and they go together. You can't separate the two. And again, with a little bit of a government contracting IT hat on, kind of gearing the conversation that way. From a financial perspective, it's really driven by growth. What is the growth today and the growth outlook for my business? What is number 1, 2, what is the margin profile of the company? What is my EBITDA because companies in this, it could be a multiple of revenue if it's a technology company, if it's a, you know, if it's a more productized software technology company, or multiple of EBITDA for a services focused company. So growth, margin profile, and then of course, and what is that visibility into the future, right? Like what is the risk, you know, in the business in terms of that financial profile in the future? So when you wed that with qualitative, you know, what are the capabilities of the company? How differentiated are those capabilities? Are they in growth areas of the market? You know, cloud, AI, you know, spaces in AI, digital, you know, agile development, software development, these all these come together in various respects. How focused and how differentiated are they? Are there proprietary tools? Are there things that are scalable in the business? So I'm not competing on the basis of people, like individual people. Am I competing on more than just people? That drives an outcome. But I would say, you know, first and foremost, from a buyer's mind in the government market, really the biggest question mark for buyers is, what is the small business profile of a company? How much small business? Because that will determine how much visibility you have into the future growth prospects of the business and their ability to sustain the growth and the performance of that business. And how differentiated is my offering that I'm providing to companies.
Actually, before you share your slide deck, that brings up a question right to my mind. When you said how many small businesses are out there, explain that, and also the differentiator, because what was going on in my mind was, if you take federal contractors, we are all the same, right? We all, maybe one services DoD more, but all of us service DoD. Maybe one services agriculture more, but we all touch many federal agencies and have vehicles in many federal agencies. And we are all small, or we all have some statuses, and we're all trying to get to full and open. How do you differentiate between all of us looking almost the same? Where are the difference points?
Yeah. A lot of it will depend upon kind of where you sit in the market. But if you think about a differentiator, you know, and we'll use like software development, you know, where do you sit in the market? Who do you compete with? You know, and how do you compete successfully? So, so one example is you may have an expertise in a low-code, no-code platform, right? So we sold a company called ITG to ICF. It was very focused in agile software development. They had a very deep expertise in ServiceNow. So when you thought about what their differentiation in the market, they were growing very fast. They had a very strong margin profile. They had all kinds of ServiceNow certifications and standards and partnerships with ServiceNow, and in addition to other, you know, they did open source as well, but they had that. So, you know, they represented, and while they were growing out of their small business size status, when we sold them, they still had a lot of small business content in the business, but you know, it was very easy to demonstrate how they were able to compete head to head against the likes of Accenture and Deloitte and be successful. And a lot of that was aligned with, you know, again, with how their certifications enabled them to carve out certain work and drive it to their own vehicles of choice. So this is an example of, you know, you know, even as a small business, not all small businesses or companies with certain statuses are created equal. You know, if there is a specialized capability where you are driving work to vehicles, or that the big question is once you become large, or a large business acquires you, or a private equity firm acquires you, because they're going to have affiliation rules and they're going to no longer qualify for that same status, are they able to maintain the work? Are there other vehicles to drive the work to, because you are differentiated in terms of what you're offering, because you have a tool or a proprietary skill set, or or something that you're competing on more the basis of than just price.
Yeah.
So again, I want to add a perspective on this, if you are okay, Pallavi. Is, you know, it could be, if you're a focused company and if you're meeting a strategic objective of a strategic buyer, it also helps with the valuation. On the other hand, if the capital transaction is happening with a private equity, they will see that more as a concentration risk perhaps compared to a more broad-based player. So also both the nature of your company determines could be one of the determining factor of what kind of exit you're looking at, and vice versa.
I
As-
completely agree with that.
So let me try to sum up what both of you said, because they were different things, right? I think Jean said if you had a specialization, it adds more value. And Abid, you were saying that maybe a broad, depending on the type of buyer, maybe a broad spectrum is more appealing to a private equity kind of person, right? Because if I take an example, I try to use Harmonia as an example because it's easy to frame a question. I've had companies that have exited, like Neti, focused on NIH. I came from the mindset that I don't want to focus on an agency because government funding keeps changing. So I wanted to have a diverse base, right? I didn't want to get caught in the wrong funding cycle for 4 to 8 years. So I am very diverse. So at any given point, the company is stable, but it doesn't have one dedicated swim lane. Is that, from what's your perspective, a plus or a minus? Because many companies might be like me.
So the way I would answer that is, it's not a plus or a minus. It is just who would be a more appropriate buyer when you decide to exit, where you can optimize value. So just as an example, in one of my past lives, we were very focused on picking up a company which was focused on HHS. And so that's all we were looking for. Even our first shortlist were companies which had more than 50%. Now you don't get 100% at times, but a significant concentration. Now, when we valued that company, some other companies were very good, but if they had 60% one department that we were focused on and 40% other business, we were discounting that other business because that was not as a strategic, that was not what we were looking for. So some seller could have got lucky. Now it's very difficult to design for that, but if we come into the market looking for an asset which is in a very specific niche and focused, and we get that, we are okay to attach a certain higher premium to that asset or less discounting to the rest of the business. And that's how you optimize value. So I'm sure when you start the activity, then the advisors like the banks and others would come and advise you on how to position the asset. And like your example, if it's a broad-based asset, then somebody who wants to enter the federal government rather than a particular department, you might be the right vehicle, because then they can scale that up after you provide a vehicle entering 5 agencies or 6 agencies with live vehicles to enter at the same time. So I think there's no one right answer for that, but every company has, and that again becomes part of how you market, how you message your strength, because finally, as an entrepreneur, as a founder, your job is to maximize value.
Maybe just to continue that part of that conversation, we worked with Neti on their sale transaction. So their focus was a huge strength for them with their capabilities. So it was very easy to identify buyers for that business because they were very focused. They filled a certain niche for certain buyers. Yes, they were 100%, they were very customer focused. And that was a big value driver in the outcome for them. ITG, the other company I mentioned, was not. They were very diversified in terms of their customer base, but they were very focused on their capability set, which is pure play agile software development. So what I would say to answer your question is, companies can either be very deeply focused on a certain customer perspective, or they can be very focused from a capability perspective, where they are very diversified across the board in terms of both customer and capability. It makes it very hard for a strategic buyer because you don't know where it fits within a strategic buyer. So it is harder the more diversified a company is. So you want it, as a seller of businesses, you want to sell your company and say, we are one of the leading providers of X capability, or we're very strong in X capability. This is how you should think about our company, or we're extremely deep in this customer base. But it makes it harder if you're diversified across the board in both. From a financial sponsor perspective, they have a greater tolerance and greater ability to absorb more diversification because they're looking for more of a platform type opportunity, but it also comes with that, they also are thinking of a greater size. But again, I think, in general, when you think about a company's positioning, you generally think about it from, here's what I'm providing from I'm very focused somewhere, whether it be the capability or the customer.
So coming back to your ITG example, earlier on you said ITG had smaller vehicles, or that's what I walked away with. So if my understanding is correct, and it had didn't have so much full and open work, by affiliation, when ICF bought it, what was the value a company like ITG is bringing? And to dovetail on that question is, do you really need to have like 70 or 80% of your work full and open, or even if your work is a lot of small, you still have value to a buyer? So I know it's a multi-pronged question.
Yeah, no, and happy to answer that. I would say this is, if in a case of ITG, we were able to prove out the sustainability of the contract base beyond the small business vehicles. That we were able to prove that out because of what they brought to bear and how they were able to shape work and drive it to vehicles that they had in their toolkit. So there's no one size fits all answer. I would say though, if your business is predominantly small business today, or some size standard, the question is what is that conversion track to full and open? Is there a case that could make that you could move it because of size, scope, complexity, or differentiated capability, that you could drive it to full and open? And have you demonstrated the ability to do that? And the answer, the number one best answer to that is you showcase your ability to win full and open, and you've started on that. And you can say, look, I've shown how I've been able to transition work to full and open. Therefore, you can see it's happened. The backup options, the plan B is finding an alternative, whether it be through a joint venture of some sort or a subcontracting arrangement with a new small business prime. But I would say those latter two options are, from a value creation perspective, far below demonstrating the ability to win on a full and open basis.
Good to hear that. Now, Jean, I know you had a slide that you and Abid were both talking about as we prepared for this chat. And I thought that was a really valuable slide. Shall we look at that now?
I would be happy to pull that up. Oops, did that come up? There we go. You see my screen okay?
Mm-hmm.
Okay, great. Now, this slide we prepared to align with your question that you had with regards to strategic alternatives facing business owners. And what this slide is various execution strategies associated with various alternatives someone would have in the market. And a bit, I will let you, jump in and talk through any of these, but, here at the highest level, I will describe this to folks. The strategies are at the top in the different colors. One is stay the course, work on your current standalone plan, and that could include making acquisitions of your own from a business. So this is just where you are today. A leveraged recap is borrowing money to get liquidity, take money out of the company simply by going to a bank or a direct lender of some sort and borrowing money to get some liquidity and take money out of the business. That's the dark blue. The next one over in that light blue is minority non-control investment, which is bringing on a minority sponsor. So you don't give up control of the business, but you bring in and infuse some outside capital in the business, either to get some liquidity, take some dollar chips off the table, or to help a growth strategy going forward. The two sale options, one is in green and the other one is in red. They're both change of control options, sale to financial sponsor. If folks think about it as a sale to private equity, and then the red sale to strategic buyer. Those are the change of control transactions. There in the orange, you see a merger of equals strategy. So combining your business with another company. As you think about a strategy, again, strategic alternatives going forward, there could be lots of reasons you might want to do that. And the last column, we've combined the concept of IPO and SPAC. They are different, but they are similar in terms of, it's accessing the public markets. And then on the left-hand side are just various criteria in terms of what it means from a value maximization standpoint, driving value, the liquidity horizon, which is how, when you can get liquidity in your business, how long it takes to get cash money out of the business. Equity retention, which is how much remaining ownership you have in the business on a go-forward basis. Management control, it could be owner's control. How much as an owner you have control and influence over the business in the future. Moving down, execution success, how the degree of difficulty in terms of, being successful with that strategic outcome, how hard it is to execute on that outcome. And then how long a transaction might take, in terms of months to consummate. Again, this is a very generic table. It's not meant to apply to all. Certainly there are different outcomes, but this is just a framework to think about various strategic alternatives that
this is a great slide, as we saw during our prep session. This very beautifully. I've never seen all the alternatives for an entrepreneur put together in such a lucid manner. And as I advise entrepreneurs to think about these alternatives, I kind of give them this 4C formula, which I'll kind of try to articulate here. The 4 C's are starting with control, what they want to do with control. It's covered here that, would you want to stay in control of the business and do a capital event, or do you want to exit the business? Second C is around capital. I think it's covered in the liquidity space over here. How much, what kind of capital you want to get. And pretty much every option is a capital event. So you get capital through every option. The third one, which I ask entrepreneurs to think through a little bit more, is, are you looking for counsel? And counsel is just to fit the word C, but advice, something broader than just a public company board can give it. But just as an example, if you have certain events where you can get better advice, because then you're part of that ecosystem and you're enhancing that ecosystem. Sometimes a private equity focused on building a portfolio of government contracts. The 4th C is connections. So, it can give you connections. So depending on what you're looking at, I think thinking through upfront as an entrepreneur, how much it is about control, how much it is about getting capital, how much it is about scaling the business up, where the counsel and connections help. Because so many, you've aptly named this, Pallavi, right, a midlife crisis where, entrepreneurs think, look, I've got it to $100 million, I've got it to 200, everybody's midlife is at a different stage, but it is somewhere in the 3-figure millions that they start thinking about this. Now, am I the right person and the team to take it to $1 billion? Do I scale it up? I also always mention, more so in the venture capital space, that the valuation curve is not necessarily a diagonal kind of a ever rising curve. It's a bell-shaped curve where there is an optimum sometimes, especially if you're riding a wave in venture capital startup ecosystem where you're working on a certain technology. There is something which could create an optimal valuation for you. So then in those cases, thinking about whether you want to scale this and keep running it, or you want to exit it, or you want to do a hybrid of the two, is a good way of thinking about it. But I think overall this puts it very well. I know you spoke about IPO and SPAC being different, but as an entrepreneur, I've one of the things that I've participated in an IPO of a company I worked for earlier, and it is a great fun, great deal of satisfaction to take a company all the way and ring the bell. And obviously, Now there are a new vehicle in the market, which again kind of enables that IPO route with a higher level of, I would say, relative success as well as speed of execution, which is the SPAC. So there are multiple options. One needs to think through what are the objectives and then select the right option.
So Abid, two questions, but let me start with what you said last first, and then I'll come back to the optimal time. You mentioned SPAC. So I researched SPACs, and SPACs actually have been around many years, but in the middle they went through, they got a little less popular, and now we hear a lot of SPACs. And I think, like me, most of the audience may not fully comprehend a SPAC and the pros and cons, or the ease and difficulty of being in a SPAC, because I've read about you go into a SPAC and then you try to become private again. There's a lot of information out there. Help us process it a little bit.
Absolutely. So let me articulate to you a little bit in simple terms what a SPAC is. A SPAC is a vehicle that enables a company to access public markets. It helps a company become a public company. So essentially the way the SPAC works is that a set of sponsors collect a certain amount of capital. I'll take some number just to make it simple. They can collect $100 million of capital, which based on the credibility of the sponsors and their thesis in terms of that, we are going to look at companies serving federal government as an example. They collect the money based on the reputation of the sponsors and the thesis. And this money, that's why they're also called blank check companies, because then investors are writing $100 million to them, committing $100 million to them without knowing what that company is going to be, based on the thesis, which they feel is a good market opportunity. There are a lot of targets, and the credibility of the sponsors who understand that market and can get a deal done. So that's where it starts. And because it starts with a blank check or money already, there is a higher level of success for closure, execution success. I know because Gene has combined both IPO and SPAC together, but relatively the SPAC ensures a relatively higher level of success compared to an IPO, because IPO is a price discovery mechanism, and sometimes we all hear a lot of times, IPOs getting pulled back because the sponsors don't get the money that they wanted. But in a SPAC, by the time the target comes into the play, there is already a pot of money available. Although not all, it could be just part of the money. Then the SPAC kind of goes IPO. So the SPAC becomes a public company, and the sponsors then start looking for a company like the ones represented over here, which are available to get de-SPAC. So that's why SPAC becomes one of the various alternatives on Gene's chart here to kind of get access to capital. So just carrying forward the $100 million example, this $100 million is sitting with trust with the sponsor of the SPAC. And suppose they valuate a company at $400 million. One of the companies that they think fits their thesis well, has a good potential, and will be acceptable to their investors. Now there could be many paths to that. One path could be that the owner, the founder, only needs $100 million. So what they do is that $100 million cash in trust is leveraged to provide liquidity to the founder, and the $300 million of the value gets rolled over, and in return the sponsors get a certain percentage of equity of the company. Now, the way, when I have studied the SPAC route, the SPAC route becomes viable only when what you spend going IPO and in terms of the underwriting cost, which itself is quite expensive, is same or better in a SPAC situation. So that means that what you need for a successful SPAC economics to work is more than just the cash in trust being transferred in the liquidity event. So most likely out of the $400 million company, the SPAC will provide the $100 million in trust, but there will be another $100 or $200 million coming from the pipe, which is, it could be a private equity investor, it could be any other institutional investor, long-term, long-only kind of people who want to participate with the company. And then after the merger, the merged company, actually the SPAC disappears, the target company actually becomes the actual surviving entity, and it becomes a public company. So it is a relatively faster route to going public, and it provides us a higher level of certainty. Although it also brings along with that the 20% or whatever is the percentage that the SPAC sponsors make, invariably is associated with the performance of the company. Again, there could be different ways in which that gets structured, but there is a level of skin in the game for the success of the merged entity, which means that the entrepreneur may end up getting a very high level of connections, and what you would get from private equity. As an example, the example I gave, if it's a government focused private equity, they may bring deals and connections and enablement. A SPAC sponsor team can do that, and part of the team could most likely migrate onto the board of the company, trying to help the company navigate the public markets, accelerate the growth, expand the business, stuff like that. Similarly, again, I'm going back to my 4Cs example. A SPAC could bring capital, a SPAC could keep the control with the entrepreneur. It could bring the connections and the counsel that is required. A lot of SPACs that we see right now, as Pallavi rightly said, a ton of SPACs are out there in the market. If you scan them, the sponsors of a lot of those SPACs are public company CEOs, public company executives who've successfully built and scaled large companies. So from a counsel perspective, from a hand-holding perspective, it may end up for certain entrepreneurs a good way to exit, simply because while you're not, in the private equity or other places, once you have a major investor, there's a level of insecurity or uncertainty that may get built, simply because, especially when the entrepreneur wants to continue. Here, after a de-SPAC, you're still a public company. You still have the sponsors as minority shareholders, so you have pretty much the control. But on the other hand, you have great counsel and skin in the game. So it's not just somebody doing you a favor, but the sponsors are going to make their money because the company is going to be successful in the mid to long term. And that is why you get those connections and counsel from some very, I would say, accomplished executives who are originally the sponsors of the SPAC. They will become accessible to the entrepreneur. And so a lot of times, especially the acquisitions I have done in my strategic capacity, the biggest question that entrepreneurs faced was this midlife crisis, which is, I'm $100 million, how do I get to $500 million? I'm $200 million, how do I get to $1 billion? And no, I don't want to sell my company to somebody else to do that. I want to do it. I want to be part of it. I want to, not only because I want to create value, but I'm so passionate about doing this that I want to learn it for myself. And sometimes, a SPAC could be a good route to enable that. So that's kind of, it's a little more complex than this, but I tried to kind of summarize it in a simple fashion of what a SPAC enables, Pallavi.
So there's a question, because if I go back to Jean's chart, right? If I, as an entrepreneur, as a business person, want to sell my business, if I go the SPAC route, I have people on me giving me direction, and I have equity. So the headache is still mine, right? Jean, doesn't make sense. No, most entrepreneurs want to go to the beach, right, and retire. Maybe I'm one of them. So for a person who doesn't know how to make $1 billion company, right? I can understand larger companies acquiring. Jean had a model earlier where you two, was it red or orange, right? Merger of equals to make $1 billion, and a SPAC may be a vehicle there. But for a smaller company, I can never claim to make $1 billion company. I think different people have strengths, core strengths, and you have to hand over the baton to the person to take it to the next. If I want to exit, why would I go to a SPAC and still have the headache? Because I really haven't exited. I only got, let's say, from a $100 million company, I got only 100 million. I didn't get a multiple of EBITDA that Jean was talking about. So what did I miss in that?
You're absolutely,
value.
You're absolutely right. So if the entrepreneur wants to give away control and kind of have high liquidity, then you pick an option from here, which is a kind of outright strategic sale, or those kind of vehicles, which a SPAC may not be the right choice for that.
So I'm right in assuming SPAC is for a person who wants to stay engaged and needs the strategic advice of vested people to make it grow to a much higher mega deal. That, Jean, brings me to another question, which was in my mind running when either Abit or you were talking. the optimal point of a sale. So I look at myself, again, I keep using my example, having sold 3 or 4 companies earlier, but maybe at values much lesser than now in hindsight, I would not have done. I want to grow my company, but growing the company also has a risk. You know, you could grow and it could just plummet down, or you could really, there's a risk associated when you're doing. So how does and most entrepreneurs think like me, you know, let me see if I can build it more and get a higher valuation. How do we know what the best time on that bell curve that I think Abid mentioned, what is the best time for a sale of a company?
Yeah. So a lot of that is 2 things. One, it does come down to what your own objectives are, right? Because, you know, often that is when we take companies to market, a growing company with good, strong backlog, with good, strong margin profile, if they continue to hold and continue to execute on that plan, 2 years from now, it's worth more than you can sell it for today, right? So, you know, so you always have that dilemma in terms of if you believe your forecast, you're going to believe your forecast more so than any buyer is going to believe in that forecast. So it's always worth more by definition, you know, when you lean in and you believe in that forecast. So again, it comes down to what are your own personal objectives as part of the business. But, you know, I'll tell you when not to go to market, when not to go to, you want to go to market where you can see where you are ramping up, but not at that peak. If you are at that peak where you're, you know, running off your backlog, you're transitioning from small business to full and open, and you're kind of running out your contracts, that's not a good time to go to market, because what that is a business that's tailing off, not a business that's in growth mode. So, you know, maybe in summary, just a generic company in any space, it's where you see yourself driving on a path. You've got a strong and defensible margin profile that's visible, a growth trajectory where you haven't plateaued, where you see yourself continuing to grow, and you see, you know, sort of the visibility, you know, into the growth opportunity in the future. So you don't want to sell as a government contractor. You don't want to sell when you're transitioning from small to full and open. You don't want to sell when you've got a major contract. Everybody's got contract recompetes. You can't always wait around for it, but like it can't be your top contract that's being recompeted, you know, next year that you're selling. You know, buyers will diligence that forecast intensively on a contract by contract basis and question the sustainability around each contract, the validity of the pipeline, the validity of the margin continuation, the margin profile of the business, the continuation of the business and the strategic positioning. They'll validate the P wins. They'll validate everything about that financial forecast, because that's what they're buying. They're buying the future. They're not buying the past. The past is just, you know, sort of illustrative, like sort of the baseline to think about the business, but what they're really buying is that future value.
And I would just add one more point to it, you know, and especially more applicable to the venture capital world and the software industry. The services industry, the good news is it's a very dispersed market. So, you know, market share, even for the best players, are in a few single-digit percentage points. But in a software kind of a market, there is a chance of a winner takes all kind of a situation, everything that we read about big tech in the newspapers. Mm-hmm. And so a good way to also, a lens to apply in addition to everything that Jean said, is what is your competitive landscape looking like? And if there is a whale in the pond out there who's trying to gobble up every contract that the small fishes are having, then you need to be sensitive to that, because that may adversely impact your business. And there is always, especially when you are following a hype cycle in any technology, and you know there are some examples in services of that as well. And if you are on the knee of the hype cycle, it's a good time to sell, because if you delay beyond that, then there is going to be a couple of winners in that, and you may or may not be the winner, and you need to be clear for yourself. Do you have the capital? Do you have the investment muscle? Do you have the team that can then become the winner and take a disproportionate market share, or you're better off exiting the business at that time?
That's good advice. So I want to pick up two questions from the chat before I carry on with the 2 or 3 questions I already have. But somebody asked, and I think we touched on it briefly, but didn't come up with a number. But the question is, what percentage of the business should be full and open for it to have a good valuation? Abid, this is mostly a federal contracting question, but it is like, which vehicle isn't under a socioeconomic status, but it's bit full and open, right? So, Jean, have you?
I'd say it depends, but if you want a ballpark, I would say at least 50% full and open. But on the full and open side, the demonstration of prime full and open wins. Does that make sense?
Yeah,
And
let me try to get a clarification here. When you say prime, full and open, it doesn't mean that if you are a subcontractor, let's say a small business won a contract and you are a larger business as a sub to that small, that work is not what you're talking about. You're talking about your prime work as full and open.
Correct.
Okay.
So in addition to small, full and open, the next question is how much of your work is prime and sub. So where you have full and open work, I think it's important to demonstrate your ability to win as a prime contractor.
Let me pick up another question that's come up twice on the chat. And this is, if a company that is not a government contractor, but a pure service provider does not have its own IP, are they less valuable as a services company?
I think, the answer is yes, they're less valuable simply because, especially, the government typically lags 3 to 5 years in the evolution of the industry. So the way I look at services and the future of services, technology services, especially going forward, is that IP and software enabled services are going to become the norm.
Mm-hmm.
And so, whether it is about automation, productivity platforms, Jean referred to the low code, no code kind of platforms, stuff that delivers developer productivity, stuff that delivers, aspects of the gig economy. Today with COVID and the virtual working,
Mm-hmm.
a lot of models are evolving, which would have a different kind of employee characteristic. It could be a part-time employee, it could be an on-demand employee, apart from traditional employees that we know, and that needs a platform for execution. So IP, I think, is a good word. Having intellectual property to be able to deliver in the next generation a form of services, which is not just putting warm bodies on chairs, is an important part of valuation of companies to be able to then survive and effectively compete and win in the next generation of services, which is here and now. I think having that IP and owning that IP does provide incremental valuation to companies.
Yeah, and I agree that having IP is valuable when that IP is known, what's a known quantity as well. As a commercial company that doesn't have IP, can those companies still be valuable? And the answer is absolutely. And the question is what is your market differentiation amongst a pure services company? So what leverageable aspects of your business, what repeatable solutions? It could be a repeatable human capital strategy. You're building the next workforce, so you have that. It could be differentiation around the application development on a low code, no code platform. So while maybe not proprietary, if you have expertise in Workday or expertise in ServiceNow, or you pick that, or if you've got, if your expertise, if you've got partnerships with cloud and have like depth in cloud, are those services businesses valuable when you're focused on that? And absolutely 100%. Those companies sell at huge multiples where they're differentiated because, they have that, they satisfy, where the market, demand is and where some of those growth aspects of the market are. So you don't have to have IP, but really where the value is that combination of growth and margin profile. And again, that, the question is, how do you scale in a pure people-based business? How do you scale that business? How do you scale that platform? So it could be, you have tools or you have a technology stack that you build on, whatever it is. There's different ways to create solutions, if you will.
Let me take you to another question on the chat. And it says, I'm in a federal market acquisition where the contracting environment is largely via set-asides and few large businesses find success. While I want to do more than commodity services, how can I maximize an eventual transaction price? Or should I explore ESOPs and a transaction that leaves the business under the small business threshold?
Oh, that's a great question.
Yep.
That's a great question. There's so much to that. Yeah. So ESOPs are, well, they're not specifically called out here. That is something like effectively, partially like a leverage recap transaction, right? Where you're using your balance sheet to transact ownership. And honestly, ESOPs are a very good way to get liquidity out of the business. You're not selling it. You may not give up, all liquidity. It's a very good way to get liquidity for shareholders, and put some of the, and empower employees to kind of take ownership and an opportunity to grow in the business. So it can be a very good strategy. It is not a sale, it's not an exit from the business. So you'll be putting, you need to think about succession planning, who's going to be running the business if you're not running it on a day-to-day basis. But look, it works for a lot of companies, and there are a lot of very successful ESOPs. If you look in the Huntsville environment, for example, it's more of an engineering. They have very high small business thresholds. They're typically 1,000 person or more. Most of those companies, because they're small businesses, their chosen liquidity path there's probably more ESOPs in Huntsville from a government contracting perspective than any other place I can think of. But there's also it's a great way to also sustain the culture and the identity of the business on a go-forward basis. And there's a lot of great ESOPs here in the Northern Virginia area that have no plans to move away from that. And I will tell you, the power in an ESOP ultimately is if over time you can get to 100% S Corp ESOP, because those companies are sustainable. They don't pay income taxes. You do ultimately get full liquidity. It takes time to affect 100% ESOP strategy, but can absolutely be the right answer when for companies that are where a transaction, a sale outside of ESOP is difficult because of size status.
That's a great answer. Thank you. I should have thought about that question myself. So when you said in an ESOP, couldn't I just let my employees buy the entire company and go retire? Or you have to, as the original owner, stay engaged?
So it's a great question. Is 100% sale to an ESOP on day one possible? It is possible. It is not easy to happen. And the reason is when you think about probably where the capital comes from to buy you out, right? So where's that money coming from? It comes from your balance sheet, how much of the business as you can leverage. So if you're $100 million business and you don't have new capital coming into the business and you want to sell your business for 100 million because it's a nice round number, you might be able to borrow 30 million, maybe. From the bank. Where's that other $70 million coming from to buy out the rest of your business? And the answer in that very ridiculously simple example I gave you is it's got to come from somewhere else. So it can come from outside investors who come in and take some sort of subordinated debt instrument in the business, right? So they don't get equity, because if you're 100% ESOP, the employees have to own all the company, but they can have a subordinated security that might bridge part of the gap. And then it comes from employees making the affirmative decision to take money out of their retirement benefit plan, because an ESOP is a qualified retirement plan, electing to take money out of their 401k plan and investing in your company. So they're making an affirmative investment to invest in your company. So yes, 100% ESOP transaction is possible. Cytor is a good example of a company that went 100% ESOP day one. Many go there over time with buyouts that occur over time. So ultimately, as a seller, you get liquidity over time, and they move to that 100% status over some period of time. There are also financial, and I'm sorry, this answer's so long, but there's also private equity firms who specialize in ESOP approaches. And if that's interesting for anybody, they can come in and help provide the capital for an owner to get liquidity, and they'll stand side by side with ESOP. The valuation multiples are also not typically as high as you might get in other types of transactions, but if you want liquidity day one, but ultimately you need somebody to run that. You need a strong management team, or you need your next CEO. If you're still invested in there, you want to make sure that happens for sure.
So as we, I'm watching the clock and we have 9 minutes left. As we summarize it, what is a typical process and timeline? And I'm going to ask 5 questions in one, right? What is the process and timeline? Does the company wanting to sell approach, or does the company that is sellable already in the radar of the buyers, and they approach? Normally they say if you're the first one to approach, it puts you on a weaker platform. So sum up this timeline and process and the ABCD of what a person like me should do, which is what the audience wants to know.
I'm happy to start.
Okay.
If you're talking about, rather than all these liquidity alternatives, you're talking about a straight sale of the business. That process generally takes about 6 months. That's how you should think about it. Once you bring on an advisor, so 6 months start to finish. I will summarize what a typical timeline looks like, but you want to get your team on board. The team I mentioned earlier, your attorney, your investment banking partner, your quality of earnings provider, your tax folks. And typically an investment banking partner can help you put together that team to be on your side, right? And be an advocate for you. And we'll use your example. So when you think about what that timeline is, you think of month 1 as the preparation, get ready to go. That means preparing your marketing material, preparing your financial forecast, preparing your data room. It's a big preparation, a lot of energy around that. Months 2 and 3 are outreach to buyers and meetings with prospective buyers in months 2 and months 3. Months 4 and part of 5 are detailed diligence with a subset of those buyers. So detailed data room diligence, question and answer trackers, every aspect of your business, corporate records, insurance, taxes, financial, real estate, benefit plans, IP, employees, everything, to get to final offers. And then the last month is negotiation and signing. And sometimes a transaction has a simultaneous sign and close, and then other times there's a sign and a waiting period for HSR, Hart-Scott-Rodino, antitrust filings, government filings, foreign ownership filings, or financing to get to a closing. So about 6 months, maybe 7, not usually much less. Fast would be 5. But that's about the timeline. And from a buyer perspective, there's not all one process fits all. You can maximize value with only one buyer. You can run a very narrow process with 5 or 10 buyers, or you can go broad to hundreds of buyers. And it really depends upon the company, the outcome, the valuation expectations, really the attractiveness of the company. Does it fit financial sponsor, check marks? There is no one cookie cutter process, but I will say there are lots of preemptive processes we've run and represented a seller, and we would tell you they got a premium value only talking to one party. And then there's others where we've gone out to hundreds of buyers. It really depends. In this government space, there's, folks like an air of confidentiality. They like to talk to highly qualified prospective buyers, not blanket the universe with their materials. So you would expect it to be, somewhere in between.
So Abid, since you play this role of a strategic advisor for a large part of your career, and you've had phenomenal success in both scaling and exiting, sum it up in terms of an advice for companies who are looking to sell.
Absolutely love to. So, I'll talk about 2 things. One is, I think Jean mentioned the process very well and the timelines after you make the decision.
Mhm.
how to go about it. I'll talk a little bit about when to make the decision.
Mhm.
Because a lot of times, and it's very unfortunate to see, but a lot of founders dissipate value after a certain time. And obviously, it's first of all not good for the founder, but it's not good for the company as well. So when you start thinking the thinking process of, are you enjoying running this, scaling this company? Because Gene used the phrase, which is a very important phrase: buyers pay for the future of the company, not for the past of the company.
Mhm.
As founders, a lot of times I've seen people falling in love with what they did in the past in the company. But as long as you're not energized every day to come to work and energize your team, because your energy radiates to the team, to say, how are we taking this from 100 to 200, from 200 to 500, from 500 to a billion? And that is what is kind of creating value.
Mhm.
And if, a lot of times, again, I see founders spending so much time in making that decision that in that time, the company starts to kind of, in some sense, stagnate, and that could become a huge value dissipator. So my number one advice would be that introspect yourself, like Bezos said, be paranoid about your
Mhm.
customer walking away. As an entrepreneur, be paranoid about value walking away out of your doors from your enterprise, and make that decision quickly. Once that decision is made that you want to exit, and then the 4C framework, or this beautiful chart that is up here, you have to make the choices of what you want to do. Do you want a outright liquidity event? Do you want overtime? Do you want to have skin in the game? You want to have an earnout? You want to keep working but take cash out? All of these options can then answer those questions of which path to take. And again, in my experience as a buyer, and especially as a large strategic buyer, sometimes buyers like processes which are proprietary, or a narrow process with limited players. And it again just depends on the buyers, simply because if it's too wide a process, they think they'll be spending much more time on it, and it may not have a certain outcome for the buyer. So those are the two things I would mention on this. But I think most important is, first, on a personal basis, like you do with your employees a lot of time, career planning. A founder has to do career planning for himself or herself, and say, what is it? If I want to go to the beach, then these are my options. If I want to keep playing this, but I need this different level of competencies and expertise, then this is what I want to do. Or if I want to do more of the same, but I need capital and I need help to do it, then this is what I want to do. Or doing nothing, or execute a standalone plan is also a good option, as long as you know what is the end objective.
Well, thank you, Abid. Thank you, Gene. I think I personally learned a lot also, because this dilemma stays in all our minds, especially in the world of federal contracting. It's easy. The work is easy once you know how to do it, and the money keeps coming if you're doing good work. But there's a point where either you yourself are not capable of taking the company to that $1 billion mark, or there's a point at which you become too comfortable, so you lack the energy. So I think as owners and entrepreneurs, we all must do introspection and time, because at the end, the one thing that's common is you don't want your company to go down. You want it to go up, whether you're taking it up or somebody else is taking it up. So a lot of valuable lessons and good advice from both Gene and Abid. Thank you so much. Really appreciate you talking to all of us. And it's a long call. I know it was 1.5 hours, but I felt we needed that to deep dive into some of these things. Really appreciate it. I'll hand it back to either Stephanie or Cindy to close off, or to Ken.
So thank you so much, Pallavi. You did a wonderful job moderating the session, and we really appreciate Jean and Abhidali for taking the time out of your busy schedule and give us a wonderful, wonderful presentation. So valuable information. On behalf of the chamber, we truly appreciate you. Stephanie, you want to say a few more words to close?
Thank you, everyone. Learned a lot. Yeah, a lot of information, a lot to learn. I learned a lot. Thank you.
Thank you. Bye-bye.
Bye.